When it comes to long-term bonds, I know people always worry when they are to buy long-term bonds. They say, what happens if I want to exit? One thing we should appreciate about treasury bonds, they are liquid investments. They are financial assets. The degree to all and ease to which you can sell your treasury bond is incredible, if I'm to explain it. Let me use this example. In the last 2 to 3 weeks, the total treasury bonds that have been traded on the secondary market have been on average 200 billion. That is not buying alone. That is buying and selling. Over 200 billion every single day. Which means, when you buy your long-term bond, a 10, 15-year bond, and 5 years down the road, you want to now to venture into a real business because now you have the mandate and you have a higher risk tolerance, and you want to sell off some of the bond or all of it, I assure you in one single day you can sell off your bond and get your money and move on. The liquidity capacity of treasury bonds is right now, and the future is even getting better. The future, the fact that there are so many people who are learning treasury bonds, who are getting interested in treasury bonds, where the demand is now increasing, that works for the liquidity. Which means, on the secondary market, you do not even need to sell it to the bank. The banks have a mandate to buy the treasury bonds, the primary dealers. But you do not need to sell it to the bank. As a club, you can start a business and say, we shall buy treasury bonds. We shall buy treasury bonds of 500 million. But every 2 years, if you want to do some other business, we can sell some of these bonds to our members. Now, anyone who has money can come and say, you know what? I will buy. I will buy. And that's okay. And they will give you a good payment for your bond because it has value in it. The only thing you must think about when you're buying treasury bonds and the buying and selling, when you buy a bond right now, the closer it reaches to maturity, so after 5 years, its price goes down because now all of a sudden, think about it this way. If you buy a bond of 10 million, a 10-year bond, and for 5 years it has been giving you a coupon, that means the remaining 5 years, someone buying it to you, they are buying that bond as a 5-year bond. They are only going to get a coupon for 5 years because you have taken out the other 5 years. So that means the price of it goes down. Secondly, when you buy a bond right now, and this is the biggest risk to treasury bonds, and especially those that are held, and tomorrow inflation goes up or interest rate goes up, and you want to sell your bond at a time when the inflation is up, it's a little bit catastrophic. Your value of that bond goes down because this is what happens. During inflationary pressures or when interest rates are high, government issues new bonds with higher interest rate. That means if me, Kakande, I want to buy a bond, I'm first interested in the government bond that is offering a higher price before I buy your bond that you bought 5 years ago. So, for me to come and buy your bond that you bought 5 years ago that you want to sell off, it has to match what the government now is offering at that point in time. So, that's the downside at a point in time selling. And the only way to avoid that, how to kind of manage it is, I always tell people, try to sell when interest rates are going down and try to buy when interest rates are going up. Because when interest rates are going up and you buy as much as possible, it means you are buying them cheaply and you are buying them at a discount. When interest rates go down, of which interest rates will always go up and down, it's a cyclic nature of business. When interest rates are going down, then your bond goes up. A bond you bought at 1 million, now it's worth 1.1. A bond, people who bought bonds in 2022, when government issued bonds of 18.5, right now they are selling them for, if you bought it at 10 million, now you are selling it at 12 million. They do not want to sell. For them to be paid that much, It's that good. So there is always that downside on the pricing, but it's not automatically a loss because you have held that bond for 5 years. You have held that bond for 7 years. It has 3-4 years to go. These 5 years you have been held for it, it has paid you a profit. You have got back your invested amount. The time when it comes for you to sell it, you get your money in one single day and you move on to other business. That, my friend, is the benefit of liquidity when it comes to treasury bonds.